Hey everybody, welcome back to the channel. Hope you guys have been doing well. In this video, I'll begin by talking about a lagging indicator that I believe the Fed is relying heavily on in order to make policy decisions. It's a lagging indicator, so I think there's a good chance that they're going to end up overshooting. But in the context of crypto and investing, I think it might be very useful in approximating the bottom. And towards the end of the video, I'm going to share with you guys one of the ways that I plan to accumulate SOL during this bear market. I just started doing it a few days ago, so it's not a proven method or model for accumulating SOL, but nonetheless, I'll go ahead and share with you guys anyways, in case any of you guys out there are also interested in experimenting with the platform. With that being said, let's go ahead and dive into this video. All right, I remember back in April, May, I was having this heated debate with one of my buddies, and I told him that the Fed is going to induce a recession. They want unemployment to go up because they can only combat inflation by addressing demand. And this is why I think it's important for all of us to just dive in and learn as much about macro as we can, because prior to this, I bought into the narrative that the Fed is inevitably going to pivot and the market would begin going back up. But it wasn't until I did my own research, I listened to Powell speak, I listened to other Fed heads speak, and at that point it became super clear to me that what they were embarking on was definitely a negative for risk on assets. And so even though I didn't sell the top, I did manage to get out of a lot of crypto positions that went down 50, 80% plus. But before, when I was having the debate with my buddy, the Fed didn't explicitly state that they wanted to bring unemployment numbers up. But now they want to make sure that their messaging is unambiguous. So they've explicitly stated that they want unemployment rates to be at least 4%. But if you look at the unemployment numbers, they're actually falling. And the average hourly earnings rose 5% from a year ago. And if you're one of those folks out there that's looking for an early pivot, you don't want to see numbers like this, because it means there's more people employed and they're making more money. And so as a result, you're less likely to see demand destruction in the economy. And if you don't get demand destruction, you're not going to bring down that CPI number. Now, even though we added more jobs in September, there is some signs of job growth slowing down because job openings went down by over 1 million. The number of job openings dropped to under 10.1 million, down from 11.2 million in July. So even though we're not near where the Fed wants us to be in terms of unemployment, we are beginning to see signs of job creation and growth slow down. And unless something breaks in the financial system, I think this is going to be the main focus of the Fed. And until they see a meaningful increase in unemployment, I think there's a very low probability that they slow down on the tightening. And I think it's important to know that unemployment is a lagging indicator. And that's a little bit concerning because if the Fed is relying on a lagging indicator, there's a strong probability that the Fed ends up over tightening, forcing a hard landing rather than a soft landing. And I'm not the only one with that view. Kyle Bass also has a similar view. He recently did an interview on CNBC. I'm going to go ahead and play that clip for you right now.
You view it as hot, or parts of it are hot? Kyle, you're with Heyman Capital Management, founder and chief executive officer. Good or bad news?
Well, I mean, when you have inflationary recessions, which is where we are, employment is the lagging indicator. It's the last thing to turn. And it normally turns 6 to 10 months in. And so I think we're all focused truly on the wrong indicator. It's a little hot, but the number of job openings dropped pretty materially in August. And I think that also happened in September. So, I know the markets don't like this, and I know the Fed's going to keep hiking, but I think we're focused on the wrong indicator.
Okay. At this point, is it how many more basis points in your view, Kyle? I mean, given that maybe they're looking at lagging indicators and everything else, we just heard they've made zero headway getting to 2% inflation. So what are they going to need?
So look, my own view is you think about the balance sheet. The Fed's balance sheet pre-global financial crisis was $900 billion. The Fed's balance sheet post-crisis pre-COVID was $4.1 trillion. That balance sheet during COVID went from $4.1 trillion to $8.8 trillion. They're just now beginning to pull almost $100 billion a month off that balance sheet. I think they're hoping to get $1 trillion off the balance sheet before they have to stop. I don't think they'll get $1 trillion off that balance sheet before they have to stop. So I still hold that we'll be seeing a pause in rate cuts a little more than a year from now.
So have to stop instead of being able to stop because they gently land us at lower inflation levels. What's going to cause them to stop? What kind of dislocation?
I mean, look, Europe's going to have an aggressive recession. Asia looks like it's in a recession. The dollar's strong, and the U.S. is already in a recession. We just keep hiking into, when you look at real GDP, we're already in a recession. I know the White House has tried to redefine the definition, but in reality, when you look at the CEO survey, that CEO survey is about as bad as it gets. You have 54% of CEOs believe that the recession won't be short, that it'll be longer than people think it is, and the overwhelming majority of CEOs believe that we're in a recession. And so I think it's important to know note that what drove our inflation, Joe, wasn't necessarily only rates, right? It was the fact that we put 40% more money into the money supply in 18 months. And we're just now starting to make that money supply contract. And that's the real thing that the Fed needs to focus on. I don't think rates are what they should be focusing on. However, called the mechanism of the rates getting into the market, call it 9 to 12 months from now. Mortgages are over 7%. For a while, they were right at 3%. We've had a 400 basis point move in mortgage rates. You're going to see the economy hit the brakes hard when the numbers start coming out from the lags.
Now, if you guys subscribe to the view that I outlined about the Fed over tightening, then you definitely have to accept that there's probability for more downside before we actually bottom. Now, long term, I think this is a high value zone to buy for crypto. So I can understand if people decide to deploy some funds here, they begin dollar cost averaging. It seems sensible to me because long term, I think the prices will be a lot higher than they are today. But short term, I can't shake off the fact that I think there's still some risks for additional downside. Now, the good thing is that the markets are becoming increasingly more efficient and they tend to price in events very quickly. And I think this has a lot to do with the fact that information travels very quickly. Investors nowadays are more informed. And also you have algos out there that are reacting to news almost instantaneously. So even though I think that we're gonna probably end up getting a hard landing and the economic conditions are probably gonna worsen over 2023, I still think the market will end up bottoming ahead of the more negative news coming out. But short term, over the next few months, I wouldn't be surprised to see a bounce before we go lower. If you look at the DXY dollar index, we're approaching a zone of resistance. So I could see some consolidation here, or maybe it hit the zone, correct, and then go up. Because in the past video, I remember telling you guys that I think that we at least go to 118, 120, if not higher. And I still think we're likely on that trajectory. And if that's the case, we're probably going to see some resistance here before we break up higher. And if you look at the yields, they're also hitting zones of resistance. The 30-year, the 10-year, and even the 2 years approaching a zone of previous resistance. And if you look at the VIX, you have a similar case of it approaching a zone of resistance. And every time it touches this area, you usually see it come back down, retest support before going back up higher. And on top of all of this, you have a record number of retail puts that were taken out. So I'm open to a short-term bounce before we see another leg down. But overall, these aren't really good signs. You don't want to see these yields climbing as much as they've climbed. I mean, year over year, almost every country has seen their yields appreciate significantly. Now, these increases in yield may seem negligible, but remember that the world has taken on a lot more debt since COVID. So just small changes can have a more meaningful impact on the real economy. So in terms of what my plans are, for the most part, I plan to remain mostly in cash. I've started to allocate a little bit. I've talked about that in my private Discord, which is free to join. Just click the link in the description below. But outside of my small purchases and the little bit of NFT trading that I'm doing on Solana, I'm mostly going to be sitting on cash and just watch everything unfold. Because on one hand, I don't think the Fed is going to ease up on the tightening anytime soon. And on top of that, while they're tightening, there's a lot that could go wrong. I mean, if you look at the Bank of England, they were super resolute on maintaining rate hikes. But once they realized that the pension funds might be taken out, they caved in. And just like the pension funds in England, there's a lot of entities out there that are super leveraged. And during this rate hiking cycle, I think they're going to be forced to deleverage. Now, the hope is that everybody is able to deleverage without causing systemic risk. But just like in crypto, where we didn't know Three Arrows Capital was leveraged until they got liquidated, I think there's a reasonable chance that in the legacy financial system, there could be entities out there like Three Arrows Capital that are super leveraged that end up bringing the market to its knees, potentially forcing the Fed to intervene. And so for that reason and others, I've decided to remain mostly in cash at the moment. All right, in this last segment, I'm gonna show you guys how I plan to accumulate SOL during the bear market. Now, the nice thing about this strategy is that if it works, it doesn't matter if SOL goes down another 50%, because assuming that the APY remains the same, over the course of a year, you should be able to double your stack. So even if the price goes down 50%, in dollar terms, you should still be pretty close to the green. Now, this platform is called Sharky.fi. It basically allows people to use their NFT as collateral to take out a loan. And to take out a loan means that you have a counterparty. And the counterparty in this case are people like me and you who put out loan offers. And if accepted, the loan gets processed. And within 7 to 14 days, you'll be paid back your principal plus interest, unless of course the loan gets defaulted on, in which case you get to keep the NFT. And this visual here basically explains it all. I'll go ahead and link this page in the description below because I think it does a really good job of giving you guys a basic understanding of how the loan works. So basically the lender, people like me and you, say I'm willing to give 40 SOL for 1 SMB. Now, if this gets accepted, 40 SOL goes to the borrower. The borrower is forced to lock up the NFT, and in 14 days or less, he has to pay back the 40 SOL plus the interest in order to redeem his NFT. So if everything goes as planned, you're going to get paid 40 SOL plus interest, and the borrower will get their NFT back. But in the event that the borrower defaults, I'll lose the 40 SOL, but I'll get the discounted NFT. The borrower gets to keep the borrowed amount, but loses their NFT. And so because the APY is so fat and that you're able to lend below the floor price, I went ahead and offered some loans. All of them have been accepted. I lent out money to UT holders, SMB holders, and a few ABC holders. Now, the reason I chose those was because UTs and ABC have a duration of 7 days. And also UT's Solana Monkey business, I think ABC has more risk, but I think these two at least, they're definitely not going to rug, and I think they have a lot of long-term potential. And they're NFTs that I plan to accumulate anyway. So if somebody ends up defaulting, I get an NFT that I don't mind holding, or I can make fat profits by selling it right away. For example, let's say you decided to go ahead and offer a loan to a UT's holder. You can go ahead and offer, let's say 106 SOL. If it gets accepted, it'll have to be paid back with interest in 7 days. And even though the default rate averages around 3 to 4%, let's say they end up defaulting for whatever reason. If you look here on Magic Eden, you can easily sell it for 119 SOL or more. I mean, if you look at the sales history, there's plenty of liquidity at that price. Or you could come over to an automated market maker and just market sell it. Personally, I think it's probably better to sell it on Magic Eden because even though you're paying a transaction fee of 2%, so at 2%, you're getting approximately 116 SOL for the UT. And if you remember, I said the loan amount was 106. So if someone defaults, you basically make 10 SOL off the loaned amount, which approximately comes out to 10% in 7 days. And on top of all of that, you're also earning Sharky reward points. For every 10 points, you can redeem them for 1 fishy token, which is going to be the platform's native token. The tokenomics hasn't been released yet, but I suspect that holders are going to be entitled to additional benefits like reduced fees. And the cool thing is that this basically supplements the yield that you're already earning. Let's say Fishy comes out and it trades at like 10 cents, and every week you were making 10,000 Fishy tokens. At 10 cents, those Fishy tokens are worth $1,000. So in addition to the yield, you also earned $1,000 worth of Fishy tokens. Now, I just made those numbers up. Nobody knows how much Fishy tokens are going to be worth in the future. We can only speculate, but nonetheless, it's a nice bonus on top of the yield that you're earning. Now, if you don't have a lot of capital to start with, or you just want to experiment with a small balance, in my view, I think ABC isn't a bad collection to start with. If you look at its price history, it's at a previous support level. This support level has been very strong. There's a lot of liquidity here. And if you look here at Magic Eden, you can see that there's plenty of liquidity at 28 SOL. And depending on the NFT you end up getting, you might be able to even sell it for more. And you can also market sell it here on HadesSwap. And part of the reason why I think ABC might be a relatively safe play is because there's a good chance that ABC is going to benefit a lot from HadesSwap's growth. The creator behind ABC is also the guy who is pushing all the innovation behind HadesSwap. And I wouldn't be surprised to see HadesSwap launch a token and ABC holders being able to stake their NFTs and earn these tokens. And long term, I suspect the success of the NFT collection is going to be strongly correlated with the success of the AMM. Over the last 24 hours, it's been number 2 in terms of total volume traded. So both Hades Swap and the ABC collection have a decent amount of momentum. And even though there's some risk involved here, I'm comfortable accumulating ABC NFTs and holding them if I have to in the event of a default. Most likely I'll be selling them for quick profits, but let's say the price drops super fast and I'm not able to break even. I don't mind holding on to the NFT because I think Hades Swap has the potential to be one of the largest NFT automated market makers on Solana. Well, that pretty much wraps up the video. Hope you guys enjoyed today's content. Don't forget to join the Discord if you guys want to be part of my private alpha group. And if you're interested in having one-on-one conversations with me and joining some of the gated channels that I have on Discord, definitely check out my Patreon by clicking the link in the description below. With that being said, this is CryptoOneStop signing out. I'll talk to you folks next time. Bye.